Stocks just keep going up every single day. And even the abysmal jobs numbers that we got last week, stock market's just rallying back like it never happened. Take a look at the NASDAQ, which is almost back to its previous all-time high. The Dow Jones has also staged a really nice recovery. S&P 500's pretty close. And even the Russell has caught a really strong bid this year, which has not been able to do for some time. But why is it that every single little dip is getting bought so aggressively in the stock market, the indices, etc.? And what does this say about currencies and commodities like gold and oil? What's the bigger picture here, and can this keep going? Knowing the answer to this can set you up to be on the right side or the wrong side of trades for the rest of this year. And in this video, I'm going to be talking about the indices and why they keep going up and what would need to change for us to change our bias. So to better outline each of the 4 reasons why I think the stock market is so strong right now, I've listed them out. We have the economy, earnings, interest rates, and / inflation, and fiscal policy. And the ultimate word that I say frequently on this channel that matters the most to the stock market and to the indices, if you trade the NASDAQ, the S&P, etc., is the word stimulus. Now, many of you are probably familiar with the Jerome Powell meme of him printing money through a money printing machine thing and money flying out at you. Well, it's a joke, but it's also serious in regards to what moves the market the most. Ultimately, stimulus is the word of the day, because if the economy is running and earnings of companies are strong and the government is spending a bunch of money or the Fed is cutting interest rates, like in the meme, the idea is that more money is flooding into the system and can be very profitable for companies, which ultimately the indices trade based on corporate earnings. So first of all, let's take a look at the economy. Is the economy in the US holding up pretty well? Well, to answer that, let's take a look at some quick data. The latest GDP statistics that came out were a better than expected forecast. So we expected 2.5% GDP growth. We got 3%. Now, it is consensus or largely anticipated that a reason for this sharp bounce back in GDP was because of the impact imports and exports have on the GDP statistic. During this period, we saw such a sharp decline in GDP because a bunch of people imported a ton of things in anticipation of Trump's tariffs causing prices to rise. Then afterwards, we saw a significant swing the other direction where people no longer were importing as much and oversized imports, and now we saw a bounce back in GDP. That being said, that doesn't discredit the fact that we had 3% GDP growth. That's very strong relative to the forecasted 2.5%, even considering the import kind of swing back and forth. We also have a tool in the Edge Finder that allows us to look at GDP growth rate projected into the future from economists. And what's really interesting here is we do still have outsized growth for US economic activity in the rest of the year. Look at it compared to other countries, and you can see like GBP, JPY, Euro, they're expecting growth, but not as much as the US is. In some ways, this makes US stocks attractive, as a lot of investment that comes into the US markets is from foreign investors. Services PMIs have also been declining, however. This is not such a positive signal, and recently we actually missed expectations. You can see if we zoom in here that we were forecasting in the latest round 51.5 for a reading in services PMIs, and we actually got 50.1. What are services PMIs? Well, it's a purchasing manager's index of services-based companies and parts of the economy, and whether they see hiring, firing, supply chains, business activities, sales growth, etc. It asks them how are they feeling about their businesses, which is why this is a forward-looking indicator and an important indicator of future economic expectations. So we've seen a little bit of decline in this area for sure, going from a 56 reading around November when there was a lot of optimism about the Trump administration taking over. We have seen that number come down to just 50.1 at this time. And the 50 reading is the mark of growth or decline. So when people think that there is growth in the economy, this score goes higher, and above 50 is considered growth expected. Below 50 is considered contraction expected in the economy based on this index's reading. Manufacturing is already in contraction territory, as it has been for the last several years, to be fair. One of the shining stars in the economy is the consumer seems to be still holding up pretty well compared to expectations. And I think a large reason for this is employment, which we'll get into in just a second. The latest round of retail sales data, which is exactly what it sounds like, it's the consumer's habits, are they out there spending money, have been really strong compared to forecast. 0.6% growth month over month compared to the forecasted 0.1%. Consumer confidence also has had a bounce back since the April lows, so people were way more scared over here, and there's been some resilience rebounding in consumer confidence recently, although still down from where it's been the last, year or so. But then we get into jobs data, and this is the shaky spot because you have a horrible number that came out last Friday and revisions lower to the previous months that were also terrible. So jobs data definitely weakened in the latest NFP report. Private payrolls, however, did beat expectations, so this is slightly better for jobs data. And then we get to unemployment rate, which is below historical averages like we discussed in yesterday's video at 4.2%. The long-term average is somewhere around 5.7 to 5.8%. So we still have a good employed populace. And I think, by the way, going back to retail sales, I think that's why we've had the consumer holding up decently well. So this paints a picture where the economy is holding up decently well holding up pretty well. However, there are some signs of slowing economic data, and that gets down to this interest rate dynamic. If we get rate cuts, that could help to keep the economy chumming along. If we don't get rate cuts, there is the possibility that the economy could continue to materially weaken and get us into some problems. Let's talk about earnings though. How have corporate earnings been for the US? Well, let's look at some of the stocks that matter. And for this, we're going to use the Stockbox's earnings report tracker, which is a new tool that we just added to the tool. If you don't have the Stockbox, I'll leave a link in the description down below to check it out for yourself. And if you send us a direct message, we'll give you 45% off the tool. If you are an existing Edgefinder member, we can get you some really special discounts as well. So for information about the Stockbox, click the first link in the description below. So Apple's earnings, we can take a look at the earnings per share estimate, which came in at 1.43. We got a reading of 1.57. That's better than expected. What about Amazon? Another really important economic indicator is the reports generated by these giant companies, and Amazon is a huge one. Earnings per share estimates, 1.33. What came in? $1.68 per share. Pretty good. How about Meta? 7.14 actual earnings per share compared to the 5.9 expected. And Microsoft smashed their expectations too. 3.65 came in, the estimate was 3.38. So for earnings, we can mostly say that stocks look good, the economy looks okay, or at least holding up, and I think we'll hold out in time for rate cuts, which are expected to occur in September. What about fiscal policy? Well, this is where some people are excited and also some people are scared. The tariff side of things, of course, is scary to the markets, but seems to be moving in the right direction. We haven't seen massive fall-offs, or it seems like, generally tariff policy or trade policy is moving in the right direction. Otherwise, the market wouldn't be up so much. And at the same time, we can talk about the tax breaks and deregulation that the Trump administration seems pretty keen on doing as well. Those are straight up positive for stocks because, again, it straight up means more money in their pockets, which they could either reuse for reinvestment and hiring, which is the optimistic, let's hope they do that, or they could just do share buybacks, making the rich richer. That's the criticism of that concept for tax breaks for corporations, businesses, etc. However, the biggest positive of tax breaks for the businesses in America is that it makes them more competitive to dominate the global stage, keep jobs here, and continue to innovate beyond what our competitor nations are doing here in the US. That's the idea between giving cuts to the businesses to make them more competitive, to keep jobs here, and to grow things faster. So the whole story looks pretty dang good for stocks. Now, barring that we get some sort of black swan chaotic event, for the most part, the indices look really strong to me, and pullbacks are dip buying opportunities until something changes in the story that I just showed. And it will eventually. At some point, some of those variables will crack and change, and we'll get a down market. It's inevitable. But for now, and for the last several months, the right call is and has been to be on the bullish side of risk assets, which are doing quite well. I remain in that camp. I've been in that camp ever since the sell-off. I really bought a bunch of stocks. I was early to the sell-off, but took advantage of the dip because, again, most of those variables did not look super disrupted to me and continue to look optimistic for the rest of this year until something changes. By the way, if you want to get access to the Edgefinder, we're going to be doing something special today. We're going to be doing an Edgefinder giveaway in our Telegram channel. To enter for a chance to win a copy of the Edgefinder, make sure to join our Telegram channel, which is where we will be dropping the information about the giveaway. To join the Telegram, there's a link in the description. We'll also pin it in the comment section below, and stay tuned. We'll be making a post later today about how you can get access to the Edgefinder for free if you win the giveaway. So all information will be available in our Telegram channel, only there. So if you don't already have our Telegram channel subscribed, click the link in the description down below. It should be one of the first links there, and you can join the Telegram, and we'll have information posted there. Also, of course, the Telegram channel is great free value. We're posting posting analysis each and every day, just in case you can't watch a video or you miss something, but you want to stay up to date. Here's some free analysis for your day. And as I mentioned earlier, just another plug, if you're interested in access to the stock box, we are offering substantial discounts to existing Edgefinder users or to subscribers of my channel. Click the first link in the description, ask about the stock box. We can get you some information on that. You can start tracking earnings, start tracking institutions through our new institutional tracker, which you can now take a look at some pretty cool stuff. Check this out really quick. So we have a whole bunch of institutions on the right-hand screen. I mean, it's a lot of institutions, and all of their positioning is tracked within the institutional tracker. So what you can see here is by default, I've left it selected all so we can keep an eye on all of the institutions here collectively that we have in the system, and we can see their biggest positionings. No surprise, NVIDIA, SPY, Apple, Microsoft, etc. We can see the biggest buys on a quarter-over-quarter basis, and we can track to see whether they're buying, selling particular different stocks. And so this is useful if you're a stock person or an index person, because it gives you an idea of what institutions are doing in their quarter-over-quarter 13F filing. So if you're interested in this, again, like I said, the first link in the description will give you some information. You can also use the pie chart to go through all the different holdings to make it easier to read. Moving on now to gold. All of this sort of all-time highs dynamics for gold, for stocks, makes gold, in my opinion, a little bit less attractive, at least for now. The reason I say that is when things are good and when people are feeling optimistic about the economy, optimistic about corporate earnings and employment, that doesn't really make gold stand out. Now, what makes gold shiny, pun intended, is when things look ugly out there. The economy looks rough, people are getting laid off, the Fed is scrambling to cut interest rates. Chaos makes gold relatively attractive. That's not what we see right now, and I think it's reflected in the price action of gold. However, you have to acknowledge and respect that despite what seems to be a pretty stable environment right now for the markets, which we can see in the VIX, by the way, which we'll show in a second, gold has not sold off dramatically either. This holding up strength from gold, in my opinion, is very impressive. Any sort of trigger that could make this thing break out, like for example, geopolitical conflict with Russia, with China, with the Middle East, etc., breaking out, some event. In my opinion, gold is almost like a coiled up spring right now. If the economy weakens, if we see more bad jobs data, or if we see, the Fed now start to scramble to cut rates, if that dynamic comes into the picture, up we go in gold, in my personal view. So I actually lean kind of bullish on gold, but I'm waiting because I don't think now is the right time. I'm waiting for a breakout in price action and any sort of pullback to give me confirmation that I think gold could be ready to explode. So I am, in a weird way, I'm bullish, but if you had been bullish the last few months, you've been sitting around watching paint dry because the chart's just gone back and forth. But just recently, the Edgefinder, for the first time in a while, generated a bullish reading on gold. And so gold and silver are both getting bullish readings within the Edgefinder. So if we get breakouts on these, I am looking for opportunities to build a long position. Just take a look at silver, which actually looks even more attractive on a technical basis than gold. We've got these nice higher lows, higher highs, and I'm looking to see if we can either break through this move here and get into the 40s for gold, or a retest of this area of support. If we still have Edgefinder bullish confirmation, I may look to get long there as well. And this is what I mean by a low volatility or calm market environment. Take a look at the volatility index for the S&P 500, the VIX, and this thing is trading at 15.85. What that's telling you is that markets expect very little future price moves on the market, right? It's a weird thing to think about, but volatility is a tradable or a traded kind of item. It's expected moves for the future are reflected in the VIX. And so when you get a big spike, people are thinking the options market specifically is pricing big moves to happen in the future. When it goes down like this, and when we're sitting at multi-month lows here, the VIX got down to 14.7. It did spike a little bit on that NFP print, but then has come down. You're talking about a VIX that's very, very low. And so this actually makes me a little bit cautious to buy stocks now, which is where I go back to, gold and indices, NASDAQ, and look at the dollar and I say, okay, even if I'm bullish on the NASDAQ, I can't justify buying it when it's already sort of in the all clear mode. When everybody's bullish, everybody thinks it's good, then I don't want to be chasing that. And because especially with a VIX so low, any little hiccup can cause volatility to dramatically spike. And actually, that's typically when I like to buy indices more, is when you get these big pops in volatility. Those tend to be the better times for me in my historical, back testing in my trading system to actually step in and buy stuff is when volatility spikes, not when everything is peaceful and good. I typically find that to be a less attractive risk reward style, because if I were to buy indices and then the VIX jumps like crazy, that could very quickly equate to a 5 to 10% pullback in the S&P 500. And for those of you guys who do like stocks and options, check this out. Today's video is sponsored by Moomoo. And if you haven't heard of Moomoo before, they're a one-stop global trading platform with over 26 million users across the US, Australia, Singapore, Canada, Malaysia, and Japan. And Moomoo offers $0 commissions on stocks, ETFs, and options trades. They also offer free level 2 data and real-time options chain data, no extra charge. And the Moomoo platform is super advanced. They offer a really powerful options trading tool, and you can even track latest public figures holdings like Nancy Pelosi's directly within their portal. And if you want to learn something about a particular stock, just ask Moomoo's AI feature. With this tool, you can ask for trading insights on your favorite stocks. And if you want to tap into what institutions are buying and selling, check out their institutional tracker. This tool allows you to explore top institutional holdings. What sets Moomoo apart is their incredible platform for researching stocks, checking out all sorts of different analyst rating tools, and insider holdings and trades. And for a limited time, as shown on the dates on the screen right now, you can get up to $1,000 in NVIDIA shares, plus 8.1% APY for US users. As you can see on the screen, please follow the criteria here and make sure to use the link in the description to get the full context behind this offer while it is available. It is available for only a limited time. And are you already trading with another brokerage, but all these tools sound pretty cool? Well, I think so too. And they're currently offering a really cool 3% match on the first $1 up to $20,000 transferred from another brokerage. So if you're looking to take your trading tools to the next level, check out Moomoo and take advantage of some of the offers available using the link and details in the description of this video down below. Now back to the video. Taking a look at the dollar index had a bit of a false start. We've talked about this recently, but essentially the economic heat map, take a look at US economic heat map page here. We still have a very neutral reading on the US dollar. We had PMIs that came in very soft relative to expectations, not very good for forward-looking growth for the economy. So that's a little bit negative. You do have some positives as well. Retail sales were stronger than expected. Inflation is a bit mixed. You have some figures like the CPI coming in line with expectations. That's a bit neutral. The producer price index was cool. That's good for inflation, bad for the dollar, but good for inflation and for stocks. And the PCE number, which came in a little bit higher than expected. That is bullish for the dollar, less rate cuts, and bearish for stocks, less rate cuts. So that's the way to read this, right? So we're looking at inflation over here. We're looking at growth metrics over here. We're looking at job statistics and housing down here. So if we take a look at, for example, let's do some housing data. I'm sorry, some labor data. Wage growth, right? Better than expected, 3.9% compared to the 3.8% expected. People are getting wage increases that are outpacing on an average indexed level the rate of inflation, which makes people feel a little bit better. That's good for the consumer. At the same time, unemployment rate, right? Unemployment rate came in line with expectations. You had a forecast of 4.2. So all said and done, the US dollar impact based on this data is getting a neutral reading. That's the utility of the Edge Finder, is it automatically scans all this stuff and just punches out a bias. That's what a lot of our users and our customers who use our software, that's what they're after, is, just give me the kind of output summary of your data. And that is ultimately what is provided here, as well as what is provided with our top setups algorithm, which generates bullish and bearish readings for each of our favorite assets like gold, silver, currencies, commodities, indices, etc. I hope that video was helpful to you. And I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.